I'm Chris Preston,
And I'm Brad Simmerman.
and welcome to Street Check, the best podcast in the history of Cabot Wealth Network, despite some challengers, new challengers that are emerging. Um, Brad, it is officially spring, which I imagine is lovely in Arizona. I bet the cacti are in full bloom, probably.
I don't know. I haven't been outside of my house in like 4 years, so
Oh,
no,
okay.
it's nice. It gets warm during the day occasionally, but it stays pretty cool, which we value before it gets scorching hot for the next 6 months.
Yep.
I don't know. Part of me wishes I could go in my pool already, but I tell that part to calm down and enjoy the cold weather while it lasts. Got some rain
Yeah.
last night. Nice.
Do you want to know what it's like here during spring here in Vermont? It is
Much.
currently 22, wind chill of 8. And there's snow on the ground. We're supposed to get another half a foot at least on Saturday.
Spring has sprung, Chris.
Spring
Spring
has
has
sprung.
sprung.
Yep. I can feel it. Okay, so let's get right into it. Brad, what's the rundown for today?
So today we are going to do our own little March Madness bracket. We are calling it Magnificent Madness. We will pick our favorites out of the mega cap tech stocks, plus one that is often left aside. We are also going to talk about convertible bond offerings by tech companies, whether that is good or bad news, problematic, etc. Of course, we'll talk about the Federal Reserve, who had the meeting yesterday, and after which the markets rallied significantly. So a little bit abbreviated today, but we'll get into it.
Yeah, and we'll start as always with defend the take. And Brad, you're up this week, and your take this week is pretty simple. In the short term, buy the consumer. You have 90 seconds. Go.
So this is more trend and sort of sentiment driven than fundamentally driven. And my caveat up top is Nike reports earnings tonight. And if Nike whiffs, then this whole premise is blown up. I don't think they will. I think we'll see a good result from Nike. But the rationale behind it is largely we're past the Fed meeting, we're past first quarter earnings. We are fully in a bull market. It is maybe a little bit exuberancy for my taste. But in a bull market, traders tend to look for underperformers that can gain ground quickly. Tech pulled us out of the bear market, and now we've seen rotation into some small cap stocks. We've seen rotation into real economy assets. Things like oil and copper are doing really well. Energy stocks are doing well. Well, one of the big laggards has been consumer-facing stocks. So consumer discretionary has not been doing particularly well. There's been plenty of negative headlines about how consumers may be tightening their purse strings as the economy as the economic recovery for them has not been maybe as quick as people had hoped. But the overarching theme here is don't fight the tape, right? We are in a bull market right now. Uh, I'm not going to fight the bull market. I've done that often enough in my history. I'm not going to do it now. Um, I'm looking for beneficiaries of broad positive sentiment with room to catch up. I think retailers, consumer-facing stocks in particular, are going to do very well, at least for the next month, right? Once we hit the summer months, it gets into that sort of sell in May and go away. We get into those doldrums, then we have next quarter's earnings coming up. But, for the next month plus 6 weeks, bet on the consumer. I don't
Fine.
necessarily mean jump in with both feet, but prioritize consumer facing names.
Good. Yeah. Could I let you go a little longer there? But yeah, good take. So the Vanguard Consumer Discretionary Index Fund ETF up only 4.75% so far year to date. Been on a nicer run since November, but they've trailed the broad market. It's as we talked about, tech, AI have really led the charge here. And with a still strong economy, I agree with you. I think with consumer discretionary retail in particular lagging a bit, there's room for improvement there. And Mike Santolo, who's our growth stock investor, expert who I really rely on for his opinions on the market and growth stocks. He's sort of rotating into to retail consumer discretionary lately. I think I think that's a smart way to play right now with AI so frothy, AI and other tech related plays so frothy.
Yeah, and I mean, ultimately, it is an acknowledgement that if you are rotating out of a sector, you have to be rotating into other sectors.
Right.
So you can't rotate out of tech and then like rotate into something that's really, really adjacent to it. You need to rotate into a different premise. And
Yep.
the real economy stuff has caught up really nicely of late. So I think consumers which, as you said, have been underperforming, or consumer stocks have been underperforming. I think they're a prime beneficiary. I still like small caps from a maybe more tactical rotation, but if you're just looking at sector rotation, I like the consumer.
Yeah, agreed. Okay, let's get into our some more main topics. Our favorite subject, the Fed, spoke again this week, but not, as it has been the case for the most part lately, it wasn't, a Grim Reaper situation. Stocks rallied to new highs after Jerome Powell spoke yesterday. It's because he reiterated the Fed's stance that there will be likely to be three rate cuts in the second half of the year. There is now actually a 62% chance, according to the Fed Watch tool, of a June rate cut, up from 59% prior. Only moved the needle a little, but still a 62% chance is more likely than not. So you were a little more pessimistic about the way he phrased things. But you know, so I guess stasis in this situation is a good thing.
Yeah, yeah, and honestly, the sort of market response to it, I think there was something that you could take away from it, and I'll give you specifics. That was more hawkish, that was more higher for longer than maybe people gave it credit for. But the market's response to it is very much telling me that we are in up only season. Um,
Yep.
so so in the December meeting, what the Fed does is they provide an expected appropriate rate range, because the Fed has the 5.25% to 5.5% as their target range, right? So they're sort of operating in ranges. And then what they do when they offer when they give you the dot plot is they say, what's the midpoint of the range? And then they give you a median. So they say this number of Fed members are below it. This number of Fed members are above it. The median plot point is 4.6, which is in the middle between 4.5 and 4.75. So that would translate to three rate cuts, or a range of, going from 5.25 to 5.5. That comes down to 4.5 to 4.75. But my takeaway from it was a little bit contrary to that. If I had to bet money right now, I would say we get two rate cuts this year, and not three. The rationale for that is in the December meeting, if you look at the summary of economic projections, there were essentially three Fed members calling for rates to be unchanged, seven that were calling for one rate cut in the course of the year, and 11 that were calling for rate cuts down to 4.75 to 5.5. So, uh, or I'm sorry, three with no cuts, seven with one cut, and then 11 with two cuts. And then you had some outliers that were on the lower end of it. What we saw was the lower end picking up to the three rate cut sort of baseline, but you also had a few Fed members that were gravitating towards no rate cuts or even rate hikes. So the sort of, it's math on math, which is, there's a lot of room for error there. The sort of consensus rate range in the December meeting based on the offered ranges is like 4.82, which is in the 4.75 to 5 middle point. So we're disregarding the median of 4.6 that they use and just looking at what their actual rate projections are. They're in the 4.8, they were at 4.82. After the March reading, they were at 4.93, which tells me that there is an undercurrent of hawkishness that has Fed members thinking that rates are going to be maybe persistently higher. The problem is when you present a range of options that, overlaps two different rate scenarios, there's a lot of room for confusion and obfuscation. Um, I read this as more hawkish, as that we will get less than three rate cuts. The market did not. No matter how much I would want to be able to override the market on anything, I can't, right? The market's too big. Everybody's going to do what their sentiment drives them to do. So I came out of that meeting more hawkish and thinking that we're probably on path for two cuts. If we want to talk about the sort of political thumb on the scale, right? If you present a picture of maybe three rate cuts and then you opt not to cut in the December meeting after the election has happened, you're sort of achieving your goal while also signaling that the three rate cuts are coming. That's good for the market. So I'm not going to attribute that to them, but I don't think it was nearly as bullish as the market took it to be. But
Yeah, it's this percent. So look, I'm looking at the CME Group Fed Watch tool numbers now. It's pretty marginal. It is up June. Chances of a 25 basis point cut is now up to 63.5%. It's gone up a little. And by year's end, so by the December 18th meeting, three rate cuts, 450 to 475 target rate is the highest number, but at 34%. 29% is four cuts, not far behind. But there's 20% chance of the two rate cuts that you mentioned. So there's not a huge disparity in projections there. And as we've seen in the past, those numbers can change very quickly. Remember, it was almost consensus that this month was when they were going to start to cut rates, and that fizzled very quickly. We were always skeptical about that anyway, but things can change quick. Yeah, if I were to take the over, or if you asked me to take the over under on 2.5 cuts for the year, I might agree with you. I might take the under too, just because that's sort of been the pattern, them slow playing this.
yeah,
London in his issue today speculated how much political pressure there'll be in an election year. They have been proven, to me, it seems like they've been not immune from that, but they haven't really showed effects of any political pressure the last couple of years with the way that they've slow played this and just been on their own timeline. I don't know if you have a different opinion on that, but seems like they're acting pretty autonomously.
yeah, and that's their. I mean, that's one of their sort of core objectives is
Yeah,
to
they're
be
supposed to.
apolitical. And
Yeah.
they try not to signal anything going forward. I mean, Powell was very intentional about his, well, my explanation is in our statement, or I'm not going to speculate on what's going to happen in future meetings. Just looking at the calendar dates for when we've got Fed meetings, uh, cut in June, cut in September, so hold in July and November, and then that sort of leaves December 18th meeting as the one where it's like, hey, maybe we get a third cut, maybe not, but yeah, I mean the November one is after the election, so yeah, cuts in June and September, hold in July, and hold for November, December would be my guess, but trying to get into that level of granularity
Yeah.
is sort of a fool's errand.
And does 2 versus 3 by the end of this calendar year, especially if like there's a third one in January next year, does it make a huge difference? I mean, it's pretty arbitrary, just like the end of the calendar year is the cutoff, 2 versus 3, whether, even if it's 1 month later or something like that.
Yeah, I mean, I even politics aside, like, is there an intrinsic value to dragging your feet on rate cuts while you're signaling that they're coming, right? Like, because part of it is how we respond, we as investors and we as participants in the economy respond to what the Fed is signaling. So if they're floating three and then they drag their feet on it and it's like, whoops, it was two, does that accomplish some of the same? Does that allow them to accomplish their mission the same way as just making the three rate cuts? Not exactly, but I think at least from a market standpoint, it's close enough for army work. When can we stop talking about the Fed entirely?
I don't know. I don't know. I mean, maybe once they start cutting, maybe, but even then, be like, oh, how much will they cut? Yeah, you and I can make the choice not to.
I don't think we can. I don't think it's up to us, right? Like
Yeah, maybe not.
the market essentially didn't trade in the second half on Tuesday. It was just holding, and then I mean it traded obviously, but no range, very little activity before the Fed decision. So if we're a market news podcast and we're talking market news, and all the market is paying attention to is the Fed,
I
I think we
know.
have to talk about it.
Yeah, I know. We'll see. Hopefully this time a year from now, we'll be in a place where we don't really have to talk about it, at least not nearly as much. Okay, let's move on to our second subject. Tech companies, in the midst of, you know, a big surge in their stock prices over the last 4 or 5 months that we've been talking about, raised $7.4 billion through convertible the convertible bond market in the last let's see, that was in February. That was the highest monthly figure since last August. Companies like Supermicro Computer, which has been on a tear, Lyft, raised let's see, Supermicro Computer 1.7 billion, Lyft 460 million. Several other companies. Explain the risk in this, or why this makes some of those companies more risky.
So very specifically, MicroStrategy is the one that this introduces an outsized risk for. Supermicro issued a convertible bond offering. I just lost the dollar amount, but
1.7 billion.
1.7. So at what would be a conversion value of 1341. So if the shares are trading at 1341, that's sort of par value for a bond conversion. Now, to trigger the conversion, the bonds have to be trading at a 30% premium to that. So Supermicro would need to be at 1743 for them to really actually get converted to an equity position. And I think the coupon rate on the bonds is like 0.625. It is, for all intents and purposes, for Supermicro, free money. And I think it's good. I think it's good decision making. I think it's a good endeavor to pursue, because what are the odds Supermicro is trading at 1743? I think they're pretty small, but for them, it's a $1.7 billion capital raise with very little risk of equity dilution, because the conversion rates, or because the conversion value is so high, and they're essentially paying no interest on it. Where I have a problem with the conversion bond or the convertible bond offerings is MicroStrategy. They offered 525 million at a conversion price of 23.27, and 800 million a week before that at a conversion price of 14.97. That would translate to an equity dilutive conversion of 1946, so about 2,000 a share for the 800 million, and about 3,000 a share for the 500 million. The problem with that is Supermicro is using their 1.7 billion to improve operations, cover their operating costs, expand, right, doing whatever they want with it. MicroStrategy is using the proceeds from their bond offering to buy more Bitcoin. It is effectively the equivalent of an individual investor borrowing money to double down on stocks. Michael Saylor, the CEO of MicroStrategy, is a big believer in Bitcoin. He calls it more like digital property than an asset class. But there is a lesson that many crypto traders have learned over the years, which is leverage will kill you. Do not leverage, because even if you pick the trend broadly right, if your timing is off by a little bit, you can easily get liquidated. Leverage kills you in crypto, and MicroStrategy is effectively leveraging their high share price to issue convertible bonds. They are taking on debt to double down on their bets on crypto. It will work phenomenally for as long as Bitcoin is flying. I have serious concerns about their ability to even stay in business in the event that there's a major crypto crash. So if Bitcoin doesn't follow its sort of exact pattern, where it's gone up for like 18 months post halving and then corrects lower, it's so much risk. It's too much risk. They're basically a high-priced Bitcoin analog that's trading at a premium to the actual price of Bitcoin based on I can't tell what.
Is this
I
more of a red flag for certain AI companies like the ones you mentioned, or that what is it called? What's the ticker symbol on that one?
So MicroStrategy's MSTR,
MSTR.
they are technically a software company, but they've essentially become a Bitcoin holding company. It
Yeah.
is a major, major red flag for them. I wouldn't touch
What
their
about
stock.
Bitcoin prices? Do you think this is, those are frothy too?
Those are incredibly frothy. The limited track record that it's got says that prices will be higher in, 18 months is when the peak happens after the halving. Will MicroStrategy's risk is it contagious to Bitcoin? I don't think so. They own about 1% of the outstanding Bitcoin. They could liquidate that amount with some sort of short-term pain, but I don't think long-term it is bad for the asset class. Um, Supermicro is obviously like not a crypto asset at all. It's a server asset, or it's a server company. Um, if they use the money well, it's great. They took advantage of a frothy market, and it's going to put their company in better position to continue operations going forward. But this is just a major, major red flag for MicroStrategy for me. And I
Yep.
will be very wrong if Bitcoin rallies to six figures over the course of, say, the next 4 to 6 months. I will look like an absolute idiot for saying this because MicroStrategy will do even better. My
Let's flag
concern
that.
is
Let's flag that statement for the next hot sauce consumption
yeah,
episode.
absolutely.
Yeah.
This is one where it's like you can carry me out of my shield on this one. MicroStrategy is a 100% stay away for
Yep.
me. This is problematic behavior for individual investors, let alone a major company.
There you go. MicroStrategies. Stay away from that. And a trend to keep an eye on with things quite frothy as we talked about in the AI and tech market. Okay, let's move on to our featured segment for today, which is a fun one. It's March Madness. Today is the first day. Today's the best day on the sports calendar. Today and
It's the
tomorrow.
first day that the real teams play, Chris. It is the
Yeah,
first day that the real teams play.
yeah, it's a touchy subject. We don't need to talk about Virginia's debacle in the first four. By the way, if that game had happened, if they had made the regular tournament and that game had happened just among 15 other games on a Thursday or Friday, no one would have gone totally under the radar. That's the
Yeah.
the other disadvantage of being in the first four, and you have sort of the stage to yourself. Everyone talks about you the next day. Even Stephen A. Smith is waiting in, who's never watched a single Virginia game ever, and is calling for the coach to be fired. Anyway, rant over. Your team plays and is among the favorites, and Vermont, in my home state, is playing Duke, and I'm going to that game Friday night.
Yeah. Don't
Um,
don't bet the house on Arizona. I don't know. Maybe I can counter indicate my way to a national championship.
Yeah, you were
I have them getting
pessimistic
beat.
about the D. Well, you weren't as pessimistic about the D-backs, but that
I had
might.
money on them to win the World Series,
That's true.
right? Like
Yeah,
I looked crazy in August. No, I have U of A getting bounced in the Sweet 16. I don't I don't think they've got it. So maybe I'll counter indicate my way to them taking a title home.
there you go. So, in the spirit of March Madness, we're going to do a bracket today of sorts that we're calling the Magnificent Madness. It is the Magnificent Seven: NVIDIA, Microsoft, Google, Amazon, Tesla, Meta, and Apple, plus one, which is lobbying to become the eighth, lobbying back in to the exclusive club, Netflix, after having a really good year plus. So we set up a bracket, 1 through 8, and let's just go through these and see what we think will do best. So the winners we're projecting are which stock will perform best through, I think we're doing through the end of this calendar year. Is that right?
Yeah.
So over the next 9 months or so. So let's start with our number one seed. What else? NVIDIA. We've talked about it recently. This is
Oh,
NVIDIA's market.
so I have to Jensen Huang. I was mispronouncing that. My apologies to Mr. Huang, the CEO of NVIDIA, for mispronouncing his name.
He's
And
definitely
to
watching.
yeah, well, I assume so. I assume
Yeah.
all of the CEOs of these major tech companies are watching. But
Yeah.
for our actual viewers, Huang is the pronunciation. My
Jensen
apologies.
Huang. Okay. Yeah, I wouldn't have known either. So Nvidia, top seed, dominated the market lately. They're up, what, 300%, something like that in the last year. And you know, they were 30% of the gains of the market in the first 2 months of the year. Number one overall seed. They're the Yukon of this bracket. Number eight, Netflix. Not because they're a plucky eight seed, because it's not because they've done poorly lately. It's just because they're only stock in this list. It's not technically among the Mag 7, but again, lobbying to get back in the good graces. Which of those two do you think will perform better through year's end?
This was actually, I think, this is my second easiest pick. The easiest one will become pretty obvious. Netflix. I'm
Netflix.
going Netflix. The frothiness, look, AI has served its purpose. It has performed exceptionally well. The semiconductor uh, companies have done exceptionally well. The market is tiring of the narrative. Semiconductors are traditionally very cyclical. I, I got to go Netflix. I'm going to lean into the sort of bet on the consumer thing that I was talking about earlier. Um, Netflix has not experienced the upside of Nvidia. It has room to catch up in an like honest to God bull market. Nvidia has seemingly topped out. I don't see a lot of impetus for investors to start piling further into it.
Yeah.
I mean, like obviously, if they come out crush earnings for the next 2 quarters, then yeah, they'll outperform it. If they come out with some brand new tech, they had a development conference recently, where essentially all they did was roll out newer, more expensive chips that are better for training large language models. I think we have seen the extent of the capabilities of the large language models as a technology, not AI specifically. I think AI as a concept still has tons of room, but large language models are going to have limited business adoption because they don't really do anything that's useful, right? Like if a large language model is hallucinating and you're just asking it for a recipe, it doesn't matter. Or if you're asking it for the best place to eat in like Kenosha, Wisconsin, it doesn't matter. But if you're a company and you have an economic interest in the outcome of what a large language model says, you can't trust that it's going to give accurate information. So the idea of all these AI powered chatbots, if you're a realtor, for instance, or a real estate company, and you're selling houses in whatever city, and you have an automated chatbot, there's a non-zero chance that the automated chatbot is going to disregard uh, industry regulations. It may not be familiar with them. It may disregard fair housing rules. I could ask a question that nobody thought about, like what is a good community for a protected class of citizens, which a realtor can't give you an answer on, and the chatbot might. I think that we are seeing the cap, the upper limit of what these large language models can do. And I think if NVIDIA is just doubling down on making more and bigger large language models, it will not pay off for them. Give me Netflix.
Okay. Yeah, I agree with Netflix. And mine's,
Really?
simpler. Yeah. It's up. So it is still, even though it's up 91% in the last year, um, it is still trailing its 2021 highs. 690 is where it topped out in late 2021. It's now at 629. Um, we've seen this resurgence. We've talked about it. It's riding Meghan Markle in Suits. Love is Blind. Also, Oscars also ran movies. And I guess Squid Game's probably coming back soon. I think it is.
Sometime
Um,
this year, yeah.
yeah.
I'm looking forward to that one.
It'll ride those back to prominence. It's restaked its claim as the, not that it ever really lost it, but the king of streaming. But it's I think it's even more
It's
obvious now. It's become the Coca-Cola, the McDonald's, um, the Nike
yeah,
of
it's the
streaming.
consensus cable replacement, right? Like
Right.
we
Yeah.
all canceled cable, we all went streaming, and now we need something that fills in what cable does, and it's Netflix now.
Yeah.
And I think
And while it's, Nvidia's up 250% in the last year, while um it's been a bad bet to bet against them. I agree with your premise, and I think it's pretty frothy right now. And I think this is the rest of the year will be, as we talked about at the top, be more of a um, consumer play year than AI play year, I think. So yeah, give me Netflix in the upset. Okay, four versus five matchup. 4, Microsoft. 5, Google. Both solid, if unspectacular, you know, evergreen plays. Um, it's toss up for me, but we just said that AI might be cooling off, and Microsoft's big gains in the last year plus, a year and a half, I guess, have been spurred by AI, by its prominence with it's not Nvidia, but it's maybe second or close in the AI sort of hierarchy, up 57% in the last year, solid, versus Google, which just sort of it hasn't been the same kind of performance as Microsoft or Nvidia. 46% in the last year. These are both solid, maybe kind of boring stocks.
Yeah.
Sort of a toss up to me. I, I guess I'll go Google, just because it's lagged a little bit, and because, as we said, the AI might be a little air coming out of the balloon of AI, and Microsoft, I think, is a little more AI dependent, or at least its run has been a little more AI dependent. So I think I'll go Google.
Yeah, this is one of like when you look at your bracket, like your actual March Madness bracket, there's always that game where it's like, yeah, whoever wins this is just going to get smoked by the number
Yeah,
one seed.
right.
So,
This is Utah State versus TCU.
right, exactly. It's like, all right, well, they're not making a deep run. I'm more on the Microsoft camp. I think Google's search is getting worse, like noticeably worse. The only reason I think a lot of people still use it is there's no like viable alternative. Google has probably more antitrust risk ahead of it.
Yeah,
Microsoft learned their lesson decades ago about not getting on the wrong side of the FTC. Give me Microsoft, but I'm not passionate about it.
right. Yeah, I this was a toss up for me, and like the returns over the last year, 55 for Microsoft, 46% Google. I don't know if it'll be quite that high through that. It won't. I don't think it'll be quite that high through the end of this year, but I could see them both being solid. If you invested in either now, you'll probably make money through the end of the
Yeah.
year, make money through the next 5 years, and the next 10 years. These are always going to be around, these companies, which is
Yeah.
maybe might not be able to say about every company on this list, but
They're both
invest in either and you'll do well. They're not the first company of these 8 that I would invest in for the short to intermediate term.
Yeah, they're both companies that like if I woke up from a coma, like if you woke me up tomorrow and it's like, Brad, you've been in a coma for 10 years. We didn't know
Yep.
what to do. We put all of your money in either Microsoft or Google. I'd say, all right, okay,
Good
okay,
enough. Yeah.
yeah, that's fine.
Yeah.
They're good companies. They,
You'd
you
sleep
know,
well at night. You'd go back into your coma thing. Yeah.
yeah,
Yeah. Okay. Next up, number 2 seed, Amazon versus number 7, Tesla. Tesla really, like, on merits over the last 6 months or so, should be the 8 seed,
yeah,
but I grandfathered it in as one of the Mag 7. Tesla's going through a rough stretch. Someone, I think it was Goldman Sachs, I think, or maybe it was Bank of America, just projected that they will have negative earnings growth in 2025. If they're coming off 2 really rough quarters, and then on top of that, their CEO keeps putting his foot in his mouth on his other toy, Twitter, X, and elsewhere. And then Amazon, eh, while not as exciting as it was, early pandemic when everyone was buying things on Amazon, it's almost become in the Microsoft Google class where you can just rely on it. And as you said, it's a good time for the consumer. Even with Tesla down, Tesla keeps proving every time you count it out, it keeps roaring back. That happened last year. The stock doubled last year after being down like 50, 60% in 2022. Um, while I think Tesla's probably likely to be higher between now and year's end, it's currently trading around 170. I mean, it's near 52-week lows. Um, Amazon, I think, is a safer play. What do you think?
Yeah, I agree. I don't like Tesla. We talked last week about how EVs were seemed the shine was the
Yeah.
shine was off them, or the bloom was off the rose, or however you want to say it. I would prefer Amazon for the balance of the year. Tesla could easily be trading in double digits by the time December rolls around. If we see negative trends in EV adoption, or the deceleration of EV adoption continue, if we see somebody like a BYD come into the US, even if it's via Mexico or via some subsidiary that is ostensibly a Mexican company that's competing on price more effectively. I don't know. There's plenty of people that are still believers in Tesla in the long haul, and it's tough to bet against them with what they've done. But
Yeah.
I do think they need to be. It's more of a show me story, I think, as Tyler likes to say.
Yep.
So I'm with you on Amazon.
Okay. And last first round matchup is 3 seed Meta, Facebook, versus 6 seed Apple. Um, Meta, I think, is second only to Nvidia on this list in terms of returns over the last year, certainly during the big run the last 6 months. In the last year, Meta stock up 157%. Whereas Apple has been lagging a bit, well, more than a bit. It's bounced back a little lately, but it's up like 13% in the last year.
Well, I
No,
mean,
sorry, 10%.
Meta fell off a cliff at the end of what 2021 into 2022. So their 1 year returns are juiced by getting absolutely smacked
Right.
down coming
Yeah.
out of the bull market. Meta is, and I'm sorry, I think I stepped on your pick. What is your pick on these?
There you go, Apple. That big a disparity in the returns, 10% for Apple. I doubt there's been a ton of years where it's only been up 10%. Especially at a time when it ostensibly the group that it belongs to, Magnificent Seven, have been carrying the market. Um, it's been the clear laggard over the last year. Because remember, Tesla even had a good year in 2023. It's really just lately that it's fallen off a cliff. But Apple's been struggling lately as well. Yeah, I do think Apple has become fairly stale in its own right.
Yeah.
They're just not coming up with anything really new. It's just turning out the latest iPhone. The streaming platform, I don't think has been. I don't think it's been the monster that they thought it might be. Um,
No.
you know, uh, you hardly hear anyone talk about Apple shows. Um, um, but I think because of that disparity over the last year, I'll go Apple through the rest of this year.
I think in my coma scenario, where 10 years from now I've been invested in one company for the duration of my coma, I would be way more comfortable with that company being Apple. But
Yep.
I think the points about staleness and sort of the lack of innovation that we've talked about, um, and this being a ostensibly 9 month contest or tournament, I will give it to Meta just from momentum and their potential upside going forward. I think it's a lot easier to sort of make a case that you're going to bring up this new innovative technology product if it's entirely software based versus if it has a hardware element. So just from that standpoint, I'm taking Meta,
Yep.
but in the long run, give me Apple.
Yeah. Let me ask you just a quick question, because I know we're running out of time. Which in 10 years, which of these two is less likely to still have its Mag 7 status?
Meta.
Agreed. I
Meta
could see
could be
both maybe not being in it. I'd say these, well,
like Meta could be out of
Apple will probably still
business
be.
in 7 years, right? It's a
Yeah.
software product, and it
Yep.
exists because it's a consensus meeting place for people on the internet. And they've made good inroads with like emerging market economies where they are effectively the internet.
Yep.
But if we all collectively wake up tomorrow and say, hey, we're not going to be on Facebook anymore, their
Mhm.
ad model fails, they don't offer anything else. TikTok, right? Like that's the nascent, or that's the newest social media platform that's favored by the young. There's nothing that stops Meta from becoming MySpace or any other failed social media company. There's no intrinsic advantage they have other than the data that they're mining from their users.
Yeah,
I don't know.
agreed. Apple, stale or not, will still be probably churning out iPhones
Yeah.
10 years from now. It probably on like a Microsoft trajectory where they're just going to be around, just not as talked about, as exciting as they were in their heyday. Um, okay, so we've got our semifinals. Number one, Nvidia, or sorry, number eight, Netflix versus, well, you have Microsoft, I have Google. Um,
I don't think it matters.
I imagine we both have Netflix over
Yep.
either.
Yep.
I think. Well, I don't want to spoil my champion might be, but I like Netflix a lot for the rest of the year. Um, and then the next matchup, number two, Amazon versus, I think we both had Apple, right? Both had Apple.
I had Meta
Oh,
for
you
the
had Meta.
balance of the year, but Apple for anything longer than that. But it doesn't matter. Amazon. I'm going
Amazon.
Amazon.
Okay, so Amazon finals of Amazon 2 seed versus 8 seed Netflix. What do you think?
This is the one I didn't write down ahead of time.
Yep.
I'm like, oh, we'll just figure it out in the moment. We'll chit chat and we'll figure something out. Give me Netflix. I'm going to take Netflix. Amazon has, their web services are incredibly valuable, but they are also degrading their selling platform, right? They're adding fees for sellers. They're starting to push promoted and paid placement for products. They're doing the same thing that Google is doing with search, which is taking the one valuable thing that they do and degrading the user experience. Netflix isn't. Give me
Yeah.
Netflix.
Yeah, I mean, I guess the question is, what are people more likely to be doing on their couch for the next 9 months? Buying things or watching Netflix? Probably both, is the is the answer. No, they're both up about the same in the last year. Netflix 91% versus Amazon 83, 84%. Um, yeah, I hate for us both to have the exact same champion. But yeah, give me the Cinderella story. Netflix 8 seed. It, Netflix is clearly has a ton of momentum, maybe more momentum than anyone other than Nvidia. And yet it still trades well below its 2021 highs. And it has a product that is in high demand right now, and it's distancing itself from the field. It's not contracting the way it
And
was maybe a couple of years ago. So
and their worst offense in the last couple of years is pushing out ad supported content, right? And
yeah,
like in the grand scheme of things, I can still get what Netflix does best, which is aggregate and produce and distribute content. I can still get that even with in an ad supported model. Whereas Amazon, with what they're doing to their product search, is having a material impact on the quality of results and the quality of product that people are getting. And I could see consumers getting fed up with that. I like that we both ended up on the same champion despite not having sort of planned this out ahead of time. So yeah,
yeah,
I like that we have Netflix. Maybe I'll go buy Netflix options now. Get like
yeah.
January 16 calls or whatever.
Yeah, there you go. Yeah, there's some good parting words before we sign off. Thanks for joining us a day early this week. It'll be a day early next week too, as we have market holidays next Friday, Good Friday, so it'll be next Thursday. The podcast will be dropping as well. Like and subscribe if you're watching on YouTube or listening wherever you get your podcasts. Apple podcasts usually. We just poo-pooed Apple, and here we are um, me on a MacBook Pro, and talking about our podcast that launches on Apple Podcasts. Thanks for joining Street Check, and we'll be back next week.